In the fourth module of the section devoted to the statement of cash flows, we shift our attention to the second section of the statement, namely cash flows from investing activities. We will start the module by taking a closer look at precisely which cash inflows and outflows ought to be classified as investing. Later, we will go over a brief example of how the cash flows from investing activities are actually derived using information about the purchase and disposal of non-current assets. IAS-7 defines investing activities as the acquisition and disposal of long-term assets and other investments not included in cash and cash equivalents. So, for example, the purchase or sale of a long-term bond would qualify as an example of investing activity. On the other hand, the placement of surplus funds in a demand deposit would merely constitute the shifting of cash to a cash equivalent, and as such would not qualify for inclusion in the investing section of the statement of cash flows. The standard provides the following examples of cash flows from investing activities: payments to acquire and receipts from the sale of property, plant and equipment, intangibles and other long-term assets, such as, for example, items of investment property. This includes payments and receipts related to capitalized development costs and self-constructed items of property, plant and equipment, for example, cash outflows related to the construction of a company's own headquarters building. Payments to acquire and receipts from the sale of equity and debt instruments of other entities. So, for example, the cash used to buy shares in other companies, invest in their bonds or extend loans to them, providing of course that such instruments do not meet the definition of a cash equivalent. Payments for and receipts from derivative contracts, such as forwards, futures, options and swaps, under the condition that these contracts are not held for trading purposes. It is important to stress that only those cash outflows which result in the recognition of an asset in the statement of financial position are eligible for inclusion under investing activities. Accordingly, expenditure that is recognized in P&L as it is incurred, for example maintenance expenses in relation to items of property, plant and equipment, or expenses related to research activities, cannot be classified as investing cash flows. A point of frequent misunderstanding is the IAS-7 treatment of dividend and interest cash flows. The standard notes that interest and dividends paid may be classified under either operating or financing activities, whereas interest and dividends received may be included in either operating or investing cash flows. It must be stressed that any of the above treatments is equally acceptable, although it could be argued that non-financial entities which do not include interest or dividends received within their revenue should also refrain from including those items within cash flows from operating activities, as these are meant to reflect the cash generation potential of the principal revenue-generating activities of the business. Accordingly, the amount of cash flow from operating activities is used as an important indicator of the extent to which those principal operating activities generate sufficient cash to replace aging or obsolete equipment, make new capital investments, service loans, and pay dividends, without having to rely on additional sources of external financing. From an analytical perspective, the requirement to show separately from other cash flows those cash flows which are associated with investing allows readers of financial statements to make important judgments with regard to whether the company is making sufficient investments in non-current assets so as to maintain its future revenue-generating potential, and whether it is not resorting to asset disposals to generate funds so as to fill the cash gap left by inefficient operations and the need to repay providers of external financing. Although generating cash in this way will typically grant the company some much-needed breathing space, it will have a knock-on effect on the company's ability to generate revenue and will typically lead to an escalation of problems in the future. Let us now turn to a comprehensive example of how the cash flows from investing activities may be derived when a company makes both disposals and purchases of non-current assets. Let's consider the following scenario. On the 31st of December 2015, the carrying amount of property, plant and equipment in the books of the company was as follows. PPE at cost equal to €200,000, accumulated depreciation of €80,000, and accordingly PPE at net book value of €120,000. On the 1st of January 2016, an item of surplus equipment, which had originally cost €20,000 when new, was sold for €8,000 but had a carrying amount of €11,000 at the time of sale. On the 31st of December 2016, the carrying amount of property, plant and equipment in the statement of financial position was PPE at cost equal to €280,000, accumulated depreciation of €111,000, and accordingly PPE at net book value of €169,000. Additionally, over the course of the year 2016, an item of land was revalued upwards by €35,000. The company performed no further disposals of PPE. It did, however, purchase several items of plant and equipment. All of the purchases, as well as the single disposal from the 1st of January, were conducted on cash terms. Let us now examine the entries which would be required in the investing activities section of the statement of cash flows. This is probably easiest to accomplish by first reconciling the movements in the PPE at cost and accumulated depreciation accounts. Let's start by displaying the opening balances of both accounts as at the beginning of the year 2016. So that's €200,000 on the debit side of the PPE at cost account and €80,000 on the credit side of the accumulated depreciation account. We can also fill in the information pertaining to the closing balances of both accounts, so that's a closing balance of €280,000 on the credit side of the PPE at cost account and a €111,000 closing balance on the debit side of the accumulated depreciation account. We are told that the item of equipment which was sold at the very beginning of the year had originally cost €20,000 when it was new, so its disposal must have triggered a removal of this amount from the PPE at cost account, which would have been recorded as a credit of €20,000. At the same time as the item's original cost is taken out of the at cost account, any depreciation which has been accumulated in respect of it must also be removed from the accumulated depreciation account. This figure is easily computed by deducting the assets carrying amount at the time of disposal, €11,000, from its original cost of €20,000 to give an accumulated depreciation figure of €9,000. Removal of this amount from the books naturally requires a debit of €9,000 to the accumulated depreciation account. Let's now deal with the upward revaluation which was performed in respect of the company's land. Given that land is typically not depreciated, the impact of the revaluation would have been limited to the PPE at cost account, which would have been recorded by a debit entry of €35,000 to this account, with the corresponding credit going to other comprehensive income, or OCI. As no further disposals of property, plant and equipment occurred over the course of the year, we are now in a position to extract the amount of PPE purchases made, which should be equal to the missing entry on the debit side of the PPE at cost account. As we can clearly see, the entries on the credit side by far outweigh those on the debit side of the account. Summing the credits, we arrive at a total of €300,000. Transferring this total to the debit side, we can see that given the opening balance of €200,000 and the revaluation of 35,000, we are still missing a debit of €65,000, which corresponds to the value of PPE additions, the items which must have been purchased over the course of the year and which we are told were all paid for in cash. In order to complete the picture, we may head down to the accumulated depreciation account and note that the entries on its debit side sum up to a total of €120,000. When we transfer that total to the credit side, we discover that the missing entry necessary to balance the account is a credit of €40,000, which obviously has a corresponding debit in the form of the depreciation expense that is charged to profit or loss. We are now in a position to provide the inputs to the cash flows from investing activities section of the statement of cash flows. These comprise proceeds from the sale of property, plant and equipment of €8,000 and purchases of property, plant and equipment with a computed value of €65,000, giving a net cash outflow of €57,000. Please note that the transactions and movements recorded in respect of non-current assets are typically associated with the need to perform additional adjustments within the operating activities section of the statement of cash flows, assuming it is prepared using the indirect approach. For example, the depreciation charge of €40,000 computed for the year would be used to adjust profit upwards. A similar upward adjustment would be required in respect of the €3,000 loss suffered upon the disposal of equipment, computed as the difference between the sales proceeds and the net book value of the asset at the time of its sale.